Welcome to my introductory market geometry series video. This is me, that's probably you. Excellence in trading through market geometry. What I'll be discussing is why I believe market geometry is the best method for trading the markets. I pretty much am an astro-based trader for timing, but timing doesn't tell me, hey, where's price going to go? How far is it going to go? Astro cycles are streaky, they come and go. Market geometry is self-optimizing. This concept of being self-optimizing, my God, is that important? If you use technical indicators, what's the big problem with technical indicators? They have a lag. They're also streaky. Sometimes they work in congested markets, sometimes they only work in trending markets, sometimes they only work in wide range market. There's no technical indicator that can handle all three types. What to speak of consistently, can't even handle one market type consistently. Market geometry holds the promise of not having a lag, and because it's self-optimizing, of being able to trade any market condition as long as the market is moving. If the market's flat, you won't even be able to apply the market geometry techniques. Thereby, it's got a safety catch. It keeps you out of trading markets you should not be trading. Now, this requires a little bit of explanation. This concept of self-optimizing, once you get this concept of self-optimizing, you're able to motivate yourself to learn it, because I'll be honest with you, using technical indicators, easy. Unless you're astrophobic and you've been provided good quality astro timing tools like I've tried to do in my prior videos on astro timing, they're easy to apply. It's very, very little work. Market geometry takes more work to apply, but the rewards are far greater. It's kind of like master level of trading. You can be a good pro trader with other methods, but if you really want to be a master level trader, I don't know of any other way than market geometry. One mistake that I made, going back to this spreadsheet that most of the people who watch my videos have already seen, is that when I made the determination that this random number series, it gave me a clue as to the process of streaks, which led me to the concept of mirrors, which dramatically improved my profitability, the concept of mirroring. See how a random, these are random numbers. If you're not familiar, 30-second review, starting with the number 1, creating a random number, adding it to the prior random number, create a random number, add it to the prior random number. So I'm creating a random number series. It looks like it's got sharp patterns. I got a nice head and shoulders here. These horizontal lines are generated randomly, and every time I hit my F9 key, I get a different chart type, and I can see all sorts of interesting things, but that's not the point. The point is, what I learned from this is that the only thing that's reliable when you're dealing with a random number series is a process called aggregation, also known as clustering, that short-term swings exist. The mistake I made initially was that I viewed the clusters as the actual trend itself, the actual upswing and downswing itself. What I came to realize after I'd been using the concept of mirroring for about a year, now we're in approximately the end of 2005, beginning of 2006, it struck me real hard that it wasn't the aggregation of a consecutive streak of numbers, it was these pivot points that are the actual aggregates. It's these pivots. Because when I started reviewing my use of things like pitchforks, Fibonacci expansions, action-reaction lines, all of a sudden it clicked that what's really aggregating is these pivot points, these significant major pivot points. And price running between them was just price doing its thing between the real significant aggregates or clusters, which are these pivot points. And I'll try to show you, not through theory or mathematical formulas, but through market action, that I believe I'm right. Theories, you know, it's like who can talk the best, who can sound the best. Market action, making money through your trading, that's reality. See, the relationship between a market price series and an Excel spreadsheet like we just looked at that's charting random numbers is that both are a nonlinear data stream. When prices, let's say, take any pivot, take this pivot. When price is moving down, there's a lot of market noise, a lot of randomness. There's clustering going on. There's aggregation of more down than up, so it's a trend down. But there's one point where price is no longer a nonlinear data stream. When you can see where my cursor is, if one more person wanted to sell here, the market would have went down another tick. You'd have a new low. This is a point, these significant pivots, where there's no more randomness and price stops being, just for a moment, it stops being a nonlinear data stream. And because of this, market geometry works better than any other tool. Let's start with this real simple market geometry example. You see, most market geometry uses price and time, like in Andrew's Pitchfork. You define 3 pivots. This circled area here, you see, if I were to take a Fibonacci retracement from pivot B to pivot C, you'd see that this is the 50% retracement in price. But it's also the 50% division in time between B and C. There's an equal number of bars to the left as to the right of this point. And that's significant. We're basically getting the 50% division in price and time, and that's why pitchforks work. That's why market geometry works. It's non-lagging. This pitchfork doesn't require any information prior to pivot A. We'll look at some other examples, but let's see if I want, yeah, here it is. The pivots used are organized in price and time. It eliminates market noise because you're focusing on the significant pivots, which are representative of a moment when price is no longer a nonlinear data stream. Obviously, it uses price and time. We'll see how it predicts future changes and trends. Precise rules are applied, very little subjectivity. It's practically impossible to automate the backtesting, but it's easily manually backtested. And it supports other trading methods, especially swing trading systems, and especially astro timers. When you combine some of the information, the techniques in my astro timing videos with market geometry, can't beat it. You see, if A were a little higher, this pitchfork would be at a different angle going down. If point A were a little lower, it would be pointing, these angles would be different. If B and C were closer together, you'd have the parallel lines closer together. In other words, with every series of pivots, this pitchfork is optimizing itself. Every time you draw a pitchfork, you're guaranteed of having an optimized pitchfork. It's amazing. Now, this is a technique popularized by Tom Joseph in the 1980s. Before he developed the advanced GET software, which was subsequently purchased by eSignal. When Tom was a trader, before he was a vendor, he made use of this combination along with one momentum oscillator. He was subtracting a 5-period moving average from a 35-period moving average. And he would plot that along the bottom, and he would look at momentum and momentum divergence. but he would use a pitchfork in either Fibonacci retracements or Fibonacci expansions. And what he was interested in was places when price and a pitchfork line and a Fibonacci support resistance level all came together. He knew he had a change in trend. He knew this was an opportunity to implement an entry strategy. For example, he might say, well, okay, I'll buy when the next bar goes above the high of the prior bar. Or if the momentum indicator, let's say up here, where it was indicating momentum divergence, you would buy right on the pitchfork, sell right on the pitchfork line, thereby getting yourself the smallest possible stop loss. So these are advanced trading concepts, but they're easy to spot visually. These techniques work on day trading time frames, daily charts, weekly charts. If you're a Forex trader, you could be having your hourly chart or your 240-minute chart, which is commonly used by many Forex traders. Market geometry, as long as you can identify clear pivots, it's self-optimizing, no lag, deals with price and time. Let's look at another example. This is an example of a Fibonacci expansion. There's no ambiguity in terms of which pivots I'm choosing. I'm using the Fibonacci expansion tool as opposed to Fibonacci retracements, and we get a similar phenomena. Not much profit here. That's excellent. We have a Fibonacci expansion line here. The pitchfork and price all coming together. Same thing here, Fibonacci expansion line. I have a video on the Fibonacci expansion tool. You can do it with Timing Solution Fibonacci Trader. This is using the much more accurate 3-point Fibonacci expansion. Most charting software uses 2 pivots. I believe the proper way to do it, the way Timing Solution has it, the way Fibonacci Trader has it, you use 3 pivots. All waves have 3 points. The crest and the trough of a wave is how waves are normally identified, but consider that the back of a wave is at a completely different height from the ground as opposed to the trough of the wave. The trough of the wave is normally much lower to the ground. So you really have 3 points to a wave. Behind the wave, the crest of the wave, and the trough of a wave. There's no such thing in nature as a 2-pointed wave. So these are more examples. As you can see, it's a 240-minute chart of the Euro-USD. These are from my archives. You can see I was using this in the year 2004. I think this one also 2004. Back then I didn't understand why it worked. That took another year and a half before I really got the full understanding of what I was doing, but I was using the techniques back then. We already covered this. Now, let me show you another way, a much more accurate way of using the Fibonacci expansion tool. I'm just trying to highlight a few features of market geometry to get you interested in watching the market geometry video series that I have on YouTube, where we go into more depth. You identify 3 pivots and you do the 3-point Fibonacci expansion, but then you also do the more common, just connect A to B and then select B again. And what I found is when I get 2 bands close together, those areas often act as support resistance levels. And you can see the values I'm using, 0.621, 1.62, traditional Fibonacci stuff. You can see it here on a 30-minute T-note chart going back to the year 2004. Wherever I have 2 bands, it'll fall right through, but it fell to a double band, came back to this one. You can see just how the support resistance levels when you use the 2-band concept. If you're using something else, now if you traded it by itself, yeah, sure, not good. No one ever said trade this by itself. You'll be using this in conjunction with other market geometry tools, and unless you're astrophobic, you'll be using it with the astro timers, and you'll be using it with momentum divergence, and you can really grab some sweet trades. This is December 2004 gold. Similar concept. You can see how nicely, again, using the 3-point Fibonacci expansion, and then the 2-point, 2-pivot Fibonacci expansion by when you have two lines relatively close together. Now, one thing I want to tell you more about market geometry, I don't have a slide for this here, but in my market geometry video series, you'll see two videos with the words ellipse in them, and they're special. The ellipse concept is really hard to grasp. I know George Baer, a financial astrologer from the early part of the 1900s. He was doing non-stop research, very strong work ethic when it came to both trading and researching, but when he discovered his way of doing the ellipse, he pretty much stopped researching, and he basically told his fan base, I think I got it. We can fast forward to another financial astrologer and a GAN student, Bradley Cohen. Again, very strong research efforts when he found his ellipse. He pretty much didn't do too much work after that. He uses a price-time vector methodology to develop his ellipse. George Baer used planetary ellipse patterns. As you know, planets don't move in circles, they move in ellipses around the sun, and he retrofitted his ellipse that way. A non-financial astrology person, a person who just used Elliott wave and Fibonacci ratios in his trading, Robert Fisher, a rather popular money manager, German now living in Switzerland, was also doing much research until he found his ellipse, and then he basically said, I'm done. He found that ellipse in the late 1990s, and at that time his research efforts came to a close, and he simply continued being a very successful money manager. His ellipse is based on phi ratios. So those are three ellipses, all completely drawn differently. I know Larry Pasavanto, another person, he doesn't really develop tools, as opposed to, he likes to go out there in the field and find out who's doing what, and he takes the best of this person, this person. When he came across George Baer's ellipse, as described in the book, The Egg of Columbus, he said it was the biggest find of his trading career. So there's got to be something there. These are not dumb people. These are above average trading people, well respected in the trading community down through many generations. And ellipses are pure market geometry. So pay attention to that ellipse video. I've got two of them out there, one describing it and then one where I just draw examples. Mine is a fourth way of doing it, but it's geared towards swing trading and it's geared towards ease of use. Let's look at another example. The same thing. You can see the double bands. Here they're acting to channel price. This is a weekly chart. You can see how many times price hit this double band. This goes back to from 2003 into the latter part of 2004. Now, there's one other method I want to show you, just to show you just how nice and easy market geometry is and how accurate it can be. This is not a bad pitchfork. You can see this no longer exists, by the way. That was retired at the end of 2008. You can see the median line is acting nice, and everything, this stopped price for a while, price stopped here, pivoted. But there's a way when price and the beginning of the pitchfork body, when you're separated by, let's say, more than 40 or 50 price bars, you can use another technique called the 50% pitchfork. Timing Solution draws it for you automatically. I do it just, here's another way of doing it if you do it manually. What you would do is you would take the Fibonacci retracement tool from this pivot to this pivot, and this would be your 50%, see here, 50% retracement between these two pivots. You draw a trend line between these two pivots, and then you take your pitchfork and you start it here. Why? Because if this point, the beginning of your median line in the body proper of the pitchfork, is a 50% retracement in price and time, then why not the beginning of your pitchfork? So between pivots 2 and 3, 50% price and time, then why not between pivots 1 and 2, 50% price and time? And when you do that, you just get another level of accuracy. You can use both pitchforks or just one or the other. But what I'm trying to show is that market geometry is self-optimizing. Both of these are optimized to current price action, and when that happens, you have accuracy. So here's a regular pitchfork. You can say, right again, that A being this pivot, it's got too many price bars from pivot B. You know, you can say, well, it's not that bad a pitchfork. I've got, you know, a nice price channel here, a predicted price channel, by the way, because by the time price got here and this became a pivot, you've got this pitchfork drawn and you're knowing this is your resistance line. You've got a channel. But when you do the 50%er, same exact chart, same exact methodology, I'm just going to, between pivots 1 and 2, use the 50% division in price and time. And when I do that, I get a completely another level of accuracy. Same exact price chart. Look at the level of accuracy difference. You can use both. Here's my resistance. Here's my support. Now, what I want to say is, you can see this takes a little bit more work. The MTV generation may not like this. You know, they like to be told, click here, click there. This is what you're supposed to notice. Now here's your reward for noticing what I just told you to notice, and please go embrace this for a while. But this requires more work, no embracing, no rewards. You have to be more self-motivated to use market geometry. But the rewards are much greater when you combine this with the astro timing videos. You have a really amazing trading system. And the other thing that you're assured of, make no mistake about this, how many traders are actually going to use any form of astro timing? Not too many. How many traders, especially younger traders who basically have a difficult time being self-motivated, are going to put up with having to 50% retracement, draw a trend line, move your... They're not going to do that. They're going to settle for crappy technical indicators. You have an advantage over other retail traders when you are able to motivate yourself to use advanced trading methodologies such as market geometry. Same thing here. I'm not showing the regular pitchfork. This is the 50% pitchfork right here. You can just see the very sweet accuracy here. Beautiful channel. When it finally broke the channel, it just went to the next channel. We already did this. We already described this, so I just have this in here again. And that brings us to the conclusion of this presentation. There's nothing I can do really to motivate you other than to show you examples of how it works. If this doesn't work for you, if market geometry is simply not, let's say you reject it because you can't automate the back testing, or you're a statistics-based person and market geometry is far too subjective, you need something more objective, then just using the astro timers with trailing stops and, you know, profit objectives based on Fibonacci ratios or prior pivots, that'll be enough to make you successful, especially when you add momentum divergence to it. So it's not that to be a successful trader you require market geometry, not at all. But if you're willing to go the extra mile and learn some of the methods that you'll see in this market geometry series, I think you'll be well rewarded. I also have to caution you one other thing. It's a very delicate subject, so You know, like I often say, tongue-in-cheek, I don't mean to offend anybody. That's just a bonus. But there is no place else in the trading world where you can get ripped off by shady vendors as in market geometry, precisely because its application is somewhat subjective. You can never nail these people for selling you inferior quality merchandise. That's a nice way of saying it. I don't care whether it's teachers from 100 years ago or new discoveries. Even the reputable ones. For example, marketgeometry.com, reputable, no question about it. But before you get what I call the good stuff, you'll spend well over $5,000. Is that necessary? I don't think so. This stuff isn't that difficult to develop on your own once you know the basics. Again, I'm not knocking marketgeometry.com is one of the more reputable, maybe the most reputable vendor out there. But boy, are they expensive. Now, I've never bought anything from them, but because I'm a market geometry person, by the way, you might be thinking, no, I've looked at your videos, I've seen your posts, you're an Astro person. No, that's one of my tools. I am a market geometry person. Make no mistake about it. Market geometry down through the past few decades has been my primary venue. I use Astro timing to support my market geometry, not the other way around. But because I've known in my circle of friends, especially here in Southern California, where I've done so much lecturing, so much public presentations over the years, people have shown me, hey, this is what you just taught me, this is what I saw in this course. So I got a lot of respect for Market Geometry Com. I just don't know why you have to spend $6,000 to draw action reaction lines and pitchforks. But anyway, do what you feel is right. Obviously, if you're a multimillionaire, spending $5,000-$6,000 on a DVD set shouldn't be a problem. But if that's not where you're at right now, I think I'm going to give you enough information in this YouTube series for you to just expand on it yourself. Good luck.